What is up? My name is Justin. I'm part of JD, and if you clicked on this video, you probably don't know anything about it trading, but you're trying to learn. So let's get right into it. So basically, the website and app that I am on is TradingView. This is what you're going to need to actually look at whatever stock you are looking at. So as you can see on the right side, we have futures, stocks. You can look at anything on here. So on your own time, just look up TradingView. And then click on a chart, any stock or future, doesn't matter. And then you'll see a chart that looks something like this. You'll see these things right here, which are called candlesticks, and we'll go into them. But first, let's navigate a little bit of TradingView. First thing is right here at the top is a time frame where it says 15 minutes. That is what I'm clicked on. So each one of these candlesticks right now are set to 15 minutes. So each one of these are at 15 minutes. And as you can see at the very bottom, you can see the change in time, 9:45. As time moves to the right, a new candlestick opens. So you can see right here in 12 minutes, a new 15-minute candle will open. And you can see that there's tons of different options, all the way from the 1 second to the 12-month, hourly, tons of them, as you can see right here. And so that's time frame. So each candlestick has their own time frame based on what time frame you choose on TradingView or whatever charting platform you use. So you might see these but not know what these mean. So let's break these down really fast. So basically, this is what each of them means. So the red candle, or aka a bearish candle, means price went down inside this time frame. So since price went down, or first, before we even go to that, this box right here would be the candle body, and then this line right here would be the candle wick, and this line down here is also the candle wick. So wicks and body. So the top of the body is where price opened, and then because it went down, it closed lower. So the close would be below where it opened, since price went down of whatever you're looking at. Vice versa for the green candle. So closed up top, opened down low. So it opened down here, went closed up here, price went up. It is a green candle. So that's what a green candle is. So at the bottom of the body is the open. This is the bottom of the body, this line right here. And then it closed at the top of the body, which would be the top right here. And the wicks stay the same. This is the highest price reached during this time period, and this is the lowest price went during this time period. So this is based off whatever time frame you clicked on this row right here. And it doesn't matter which one you use. Just an important factor to know is that higher time frame holds higher power. So we're going to get into trends and other confluences. So you'll see all these things on every single time frame, but if you see one in a higher time frame, it is better than a low time frame. But we'll go into some very basics of what the market is made up of and some market structure. So first thing would be the market is made up of highs and lows. A high is a move up and a move down, as seen right here. And then a low is a move down and move up, as seen right here. So moving into trends, we will go into our first trend, an uptrend, which would be higher highs and higher lows. So let's clear this up a little bit right here. Higher highs and higher lows. So we know a high looks like that, and a low looks like that, a V-shaped down. So we can mark out our highs and lows. This is our high. And then we create another high. So we have high, 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 high. Every one of these highs is higher than the next. So they're higher highs, and then here are our lows. A low right here, low right here, low right here. Every low is higher than the other low. We have higher highs and lower highs. So I'll mark out this. Write this down in a notebook if you have one, just to help memorize this, but eventually it just becomes second nature. Yeah, so higher high, lower high, higher high. Oh, sorry, not lower high. Oops, my bad. Higher low, higher low, higher low. So each of the other lows is higher than the next. So higher highs and higher lows. That is a uptrend. Downtrend is the exact opposite. Lower lows and lower highs. So I'll draw it out right here. Lower low, lower high, lower low, lower high, lower low, lower high. All right, lower low. So as you can see, downtrend consists of lower lows and lower highs. Pretty simple. It's just a pattern, and obviously, like when you're looking at candlesticks, it's not going to be completely perfect lower low as like this arrow drawing I'm drawing. Um, but basically, essentially, if the market's essentially moving like this upwards, we are in an uptrend, and overall, if we are moving downwards like this, we are in a downtrend. Um, so key takeaways: uptrend, higher highs and higher lows, and then downtrend would be lower lows and lower highs. Our third trend, or not even a trend, a third way the market moves uh, would be consolidation or just like sideways. Um, Consolidation would just be neither of these. Like we're not making lower lows or like we're not in a pattern at all. Market's just kind of consolidating or moving sideways. Whatever term you like better, both mean the same thing. But there's no trend here, complete just sideways randomness. And you want to avoid trading in consolidation or sideways markets and stick to trending markets and trade with the trend. Don't trade against it. But we are going to get into like our first concept of actually reading price action and understanding like when the market might reverse. Because let's just take this right here. We are in an uptrend. Uptrends are not going to last forever. No trend is going to last forever. They are going to be broken. So our first concept is break a structure, or BOS for short. But essentially, all break a structure is when this pattern or trend that we are in ends. So instead of making another higher low, we make a lower low instead. So the break a structure is located once the most recent low gets closed below. I'll say that again. Once the most recent low gets closed below. So this is our most recent low, and it gets closed below. The candle has to fully close below it. So that bottom of the body candle has to close fully below it to be considered a break of structure. So right here would be our break of structure. And I will show the same thing on a downwards example. But anyways, break of structure, what it signals to us is that we broke structure, that we are no longer in an uptrend, that we might flip into a downtrend. So that we might start creating, after this break of structure, that we might start creating lower lows and lower highs, that we might switch to a downtrend. And then I will show you an example of a downtrend getting broke to the upside. So let's go like this. Draw our downtrend, lower low, lower high. All of a sudden, we make a higher high. So in this case, it would be located at the most recent high that gets closed above on a downwards example. So the break of structure would be our most recent high gets closed above. Since we did not continue that pattern of lower lows and lower highs, and in this case, we created a higher high, the break of structure would be located right here once this closes above the most recent high. So this would be our break of structure right here, BOS. So that is our break of structure right there. And again, signaling, not guaranteed, that we may switch into an uptrend and start making higher highs and higher lows. Should be pretty simple. And this is no guarantee that it's going to switch just because you see break of structure. You want to add other confluences as we keep learning. But that is all I have for today. I plan on making a multi-part series, keep doing this every week until you pretty much have our full strategy. But if you're looking into getting one-on-one mentored by me, you can check the link in the description. But just for today, you learned break of structure, highs and lows, candlesticks, and then just getting started on the basics. I would say like my homework for you guys is to just check out TradingView and look at the market. Get on a demo account if you want and just start taking guesses. Um, don't throw real money into the markets yet. You're not there yet. But just take guesses. Try to see and just watch price action move to understand the market more. And you'll just get better over time. I mean, it takes time. We'll learn more confidences as we go along. But drop your not comments. Drop questions in the comment section, and yeah, let me know. I'll be posting a part 2 pretty soon.